Warren Buffett on how to grow small sums of money. Warren Buffett is widely regarded as one of the most successful investors of all time, and he has provided valuable insights on how to invest wisely. His advice can be summarized in a few key tips. First, start early and take advantage of the power of compounding. Second, buy low-cost index funds to gain broad exposure to the market. Third, avoid debt and focus on long-term goals. Fourth, keep it simple and stick to a diversified portfolio of low-cost index funds. Fifth, be patient and avoid trying to time the market. By following these tips, investors can increase their chances of success in the stock market. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. Start early. Starting early is one of the most important pieces of advice Warren Buffett gives to investors. By starting early, investors can take advantage of the power of compounding. Compounding is when the returns on your investments generate additional returns over time, which can lead to exponential growth in your portfolio. Even small amounts of money invested early can grow significantly over time. This is because the longer your money is invested, the more time it has to grow. By starting early, investors can also weather the ups and downs of the stock market, as they have more time to recover from any losses. Buy low-cost index funds. Another key tip that Warren Buffett often emphasizes is the importance of buying low-cost index funds. Index funds are a type of investment that tracks a specific market index, such as the S&P 500. By investing in a low-cost index fund, investors gain broad exposure to the market at a low cost, as these funds typically have low fees and expenses. Index funds also offer diversification, which means investors can spread their investments across many different stocks to reduce the risk of loss. As Warren Buffett famously said, consistently buy an S&P 500 low-cost index fund and stick with it for the long haul. Avoid debt. Warren Buffett is known for his conservative approach to investing, which includes avoiding debt. Debt can be a burden on your finances and limit your ability to invest in the stock market. By avoiding debt, investors can focus on building their portfolios and achieving their long-term goals. Instead of taking on debt, Warren Buffett suggests living within your means and saving money to invest in the stock market. This approach not only helps to avoid the financial stress of debt, but it also allows investors to take advantage of the power of compounding and grow their wealth over time. Focus on the long term. Another key piece of advice from Warren Buffett is to focus on the long term when investing. Short-term market fluctuations can be unpredictable and lead to emotional decision-making, which can hurt your portfolio. Instead, investors should focus on their long-term goals and develop a strategy to achieve them. By holding investments for the long term, investors can benefit from the power of compounding and ride out short-term market volatility. This approach also allows investors to avoid trying to time the market, which is a notoriously difficult and risky strategy. In short, by focusing on the long term, investors can build wealth steadily and reduce their risk of losses. Keep it simple. Warren Buffett is a strong advocate for keeping investment strategies simple. He believes that complicated investment strategies often lead to confusion and mistakes. Instead, he suggests that investors stick to a simple strategy of investing in low-cost index funds and holding them for the long term. By keeping it simple, investors can avoid unnecessary expenses and focus on the fundamentals of investing. Moreover, a simple strategy can be easier to stick to over the long term, which is crucial for building wealth. As Buffett once said, there seems to be some perverse human characteristic that likes to make easy things difficult. By keeping it simple, investors can avoid this trap and build wealth more effectively. Be patient. Warren Buffett often emphasizes the importance of patience when it comes to investing. Patience is essential because the stock market can be unpredictable, and short-term gains can quickly disappear. By taking a patient approach, investors can avoid making impulsive decisions that could hurt their portfolio. Instead, they should focus on their long-term goals and stick to their investment strategy. Moreover, patience allows investors to take advantage of the power of compounding, which can lead to significant wealth accumulation over time. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. By being patient and staying the course, investors can achieve success in the stock market. Don't try to time the market. Warren Buffett advises investors to avoid trying to time the stock market. Timing the market involves buying and selling stocks based on predictions about market movements, which can be notoriously difficult to predict. Instead, Buffett suggests that investors should focus on buying and holding a diversified portfolio of low-cost index funds. By avoiding the temptation to time the market, investors can avoid costly mistakes and benefit from long-term gains. Moreover, by staying invested in the market over the long term, investors can ride out short-term market fluctuations and benefit from the power of compounding. As Buffett once said, "Our favorite holding period is forever." By adopting a long-term mindset and avoiding market timing, investors can increase their chances of success in the stock market. Avoid high fees. Another important piece of advice from Warren Buffett is to avoid high fees when investing. Fees can eat into investment returns, so it's important to choose low-cost investment options whenever possible. This includes investing in low-cost index funds, which tend to have lower fees and expenses compared to actively managed funds. By choosing low-cost options, investors can keep more of their returns and increase their chances of long-term success. Moreover, high fees can be a significant drag on investment returns over time, so it's important to pay attention to fees and expenses when selecting investments. As Warren Buffett once said, "The less you pay in fees, the more there is for you." By avoiding high fees and expenses, investors can keep more of their hard-earned money and increase their chances of reaching their investment goals. Invest in what you understand. Warren Buffett's advice to investors is to invest in what they understand. This means that investors should only invest in companies and industries they have a good knowledge of, and not invest in things they don't understand. This way, investors can make informed investment decisions, avoid costly mistakes, and identify good investment opportunities. Buffett himself has famously invested in companies like Coca-Cola and Geico, which he has followed closely for many years. By sticking to what you know, you can increase your chances of success in the stock market. One way to invest in what you understand is to look at the products and services that you use in your daily life. Stay the course. Stay the course is a key principle that Warren Buffett emphasizes. It means staying focused on your long-term investment goals and not getting swayed by short-term market fluctuations or news. By staying the course, investors can avoid making impulsive decisions and increase their chances of achieving long-term success in the stock market. Warren Buffett's tips on how to grow small sums of money can be summarized as follows. Start early. Buy low-cost index funds. Avoid debt. Focus on the long term. Keep it simple. Be patient. Don't try to time the market. Avoid high fees and invest in what you understand. By following these principles, investors can increase their chances of long-term success in the stock market. Remember, investing is a journey, and it requires patience, discipline, and a willingness to learn. By applying these tips and staying the course, you can build a solid foundation for your financial future and achieve your investment goals. Did you learn something new that you didn't know before? We hope you did. So, if you're interested in learning more amazing facts, make sure to subscribe to our YouTube channel and hit the bell icon to get notified by our new videos. Please like and share the video. Don't forget to comment down your views on this. Thanks for watching till the end.